Every day, millions of participants drown under a relentless flood of financial media. Between conflicting earnings reports and pundit predictions, extracting actionable data feels impossible. This noise isn't new. For over a century, the market has been a chaotic collision of human psychology, panic, and greed, playing out on crowded trading floors long before the digital era. To navigate this environment, the professional trader must develop a filter. They must systematically strip away the emotional noise and locate the ground truth of the market. That filter is technical analysis. It is the rigorous, systematic study of pure market action. A technical analyst sets aside external news and narratives to focus exclusively on the math of what is actually happening. This discipline operates on a specific mechanical premise, that because every transaction is recorded on the chart functions as a comprehensive record of every participant's decision. To understand how a macro chart functions, we have to deconstruct the market down to its absolute micro level, a single transaction between two competing humans. This diagram illustrates an order book, the foundation of market mechanics. On the left, we have the bid. This is the highest price a buyer is currently willing to pay. On the opposite side is the ask, representing the lowest price a seller is willing to accept to part with their shares. The empty space between them is the bid-ask spread. This spread is the measurable friction between buyers and sellers, representing a standoff in market conviction. The exact moment these two forces compromise and an order executes, a transaction occurs. That transaction plots a single permanent price point onto our grid. Multiply this single collision by millions of executions a day, and we get volume. Volume is the total number of shares traded, providing the literal weight behind every directional move in price. High volume creates liquidity. When a market is highly liquid, massive amounts of capital can enter and exit positions smoothly without violently disrupting the current price. All of this execution is facilitated by a broker. Whether an institution or an online platform, the broker is the necessary infrastructure routing these millions of bids and asks into reality. By breaking down this process, we arrive at a critical conclusion. Price and volume are the only objective, real-time truths in the entire financial system. Everything else is merely an estimate. This brings us to the first and most critical axiom of technical analysis. Market action discounts everything. This philosophy stands in direct opposition to fundamental analysis, which attempts to value a company by evaluating its internal business metrics and economic health. The vulnerability of the fundamental approach is that its data is inherently delayed. Earnings reports and corporate filings are backward-looking documents subject to human interpretation. This split screen highlights the contrast. On the left, fundamental analysts focus on metrics like price-to-earnings ratios, book value, and quarterly profit margins. But the global market acts as a real-time compression algorithm. The moment those earnings are public, millions of participants react, instantly pricing all of that fundamental data directly into the stock's price on the right. The market executes this compression on everything. Even massive physical, real-world assets like reserves of gold bullion are abstracted and compressed into a single, highly liquid digital ticker. It doesn't stop at balance sheets and physical assets. Global news, political events, and the aggregate weight of human panic and optimism are all immediately digested and reflected in the current trading price. This enforces the law of supply and demand. If the price of an asset is rising, it indicates current demand is outpacing current supply, regardless of what the delayed fundamental reports might claim. The professional chartist survives by studying the real-time result, the pure price action, rather than endlessly trying to guess the fundamental cause. Once you accept that price is the primary truth, you must apply the second core premise. Prices move in sustained trends. Zooming out on a chart reveals broad macro environments. We see bull markets, which are characterized by periods of aggressive, sustained buying. Conversely, we see bear markets, characterized by defensive, sustained selling that drives asset values down over an extended period. This chart shows how a technician maps these environments. By connecting a sequence of higher lows during a climb or lower highs during a fall, the chartist visually identifies a dominant trend channel. The erratic movement within this channel is volatility. It is normal for the price to move rapidly up and down, testing the boundaries of the trend line without actually breaking it. You must distinguish normal volatility from an actual structural break. When the price cleanly pierces the established trend line, it signals a shift in market psychology and a potential reversal. The technician's goal is never to predict the absolute top or the bottom of these moves. Their objective is simply to identify the trend and align their capital with its established momentum. These trends demonstrate how supply and demand imbalances can sustain themselves, reflecting the aggregate conviction of the market over time. Because price action dictates reality, knowing why a stock should logically move is often irrelevant. Markets are frequently hijacked by pure, raw mechanics that defy fundamental logic. The clearest example of this mechanical takeover occurs during the act of shorting, an investment strategy where a trader bets on a company's failure. The mechanics of shorting require the investor to borrow shares from a lender and instantly sell them on the open market. The goal is to wait for the price to drop, buy the shares back at a cheaper rate, and return them to the lender while pocketing the difference. But this creates a structural vulnerability. If downward, the short seller faces a disaster. This is because shorting carries unlimited risk. A stock's price can only fall to zero, but theoretically it has no ceiling. This chart models a short squeeze. As the price climbs, short sellers panic. To cut their mounting losses, they are mathematically forced to close their positions, which requires them to buy back the shares. This forced purchasing creates a feedback loop. Short sellers buying back shares drives the price even higher, dragging in more momentum traders and causing a vertical spike without a single fundamental change to the company. A short squeeze demonstrates that under specific conditions, liquidity and raw mechanics can completely override external valuations. Zooming out, the framework of technical analysis relies on non-reality. The stock chart is the visual footprint of global data and human psychology, resolved at the point of execution through supply and demand. While trading technology has evolved, the core discipline remains. Reading pure market action has been a reliable edge for over a century, tracing back to the earliest ticker tapes spooling out raw data. The amateur often argues with the market when a stock's behavior contradicts their research. The technician reacts to the trend currently in motion. To interact with this data without emotion, technicians utilize structural tools to manage their execution. They deploy limit orders, which execute a buy or sell only at a strictly predetermined price, enforcing exact entry targets. More importantly, they employ the stop-loss order. This is a defensive mechanism, an automatic trigger designed to immediately sell a position the moment a technical trend is broken. Combined, these tools allow the trader to pre-program their risk management based on the chart's architecture, removing the need for manual decision-making. Understanding the anatomy of price action is the required foundation for navigating the market's noise. With this mechanical framework established, we begin applying specific technical indicators to exploit these very mechanics.